Dead on arrival. That's what the second-ranking Republican said about President Biden's request that Congress pass a 3-month suspension of the federal gas tax. Everyone knows prices at the pump are outrageously high, but what happens to gas prices if the president fails to get his fellow lawmakers to move on his request? Are prices headed even higher? Hi, everyone. I'm Veronica Dudo, and welcome to Buy, Hold, Sell. To answer these questions, let's bring in the traders, Tobin Smith, Todd Schoenberger, Justin Wine, and joining us for this segment, senior oil and gas equity analyst from Bloomberg, Fernando Valle. Okay, Fernando, gas prices did manage to slip below $5 per gallon this week, but do you think further declines are in store, or should we brace ourselves for more pain at the pump?
Veronica, great to be here. I think that is a question of whether we're heading into a recession or if we're not. The supply and demand balance remains really favorable towards the refiners and the oil and gas companies. We don't have enough crude oil supply. We don't have enough refining capacity, especially in North America and Europe, to meet the current level of demand. Now, if we see a significant drop in demand because the Fed rate hikes, inflation are impacting consumers, et cetera, then we could see that come into closer balance. But that means that's still a significant pain left for the consumer in the next couple of months.
But Todd, we're heading into the peak driving season. Do you think that there would be any way that demand would drop?
No, not at all. And we haven't seen that yet. You would expect to see demand destruction, but Americans haven't curbed any of their spending right now. I mean, maybe they have it at the Targets and Walmarts, but not when it comes to driving. Actually, AAA is actually saying that we are going to have a record number of travelers coming out and driving on the 4th of July weekend. And with that, with more people driving, as well as a potential hurricane. Remember, guys, we are just getting into this hurricane season. Yeah. Once you start hearing about a Cat 4 or Cat 5 going into the Gulf of Mexico, you're going to really see prices at the pump go higher. So I'm not exactly sure there can be very much done here out of Washington.
Now, Toby, we're even seeing opposition within the Democratic Party over this proposal. Do you think it's just a Band-Aid?
Well, not only is it a Band-Aid, it's like a Make-A-Wish Foundation deal. The idea, again, I'm just about macro and microeconomics, okay? If you cut the price of gasoline, more will be used at a time where we have an extremely tight supply, which will make the price go up. I mean, it was about as silly as Gavin Newsom was going to send out $1 or like $100 of gas cards to every Californian, which would only make the price go up.
Right.
I don't know where, again, I know how desperate politically Biden is and how this is a political type stunt. And hey, we have politics.
It's
because
symbolic.
If we don't have politics, if we don't have politics, then we go shoot each other, okay? So I understand this, intellectually, but actually economically, it's the complete reverse. And demand destruction, to Todd's point, is coming down in the sense that what people are doing now is they're buying, if they need to go 60 miles, they're buying 60 miles of gas, maybe 70, and then they're going out, and when they have to come back, they buy it again. So it's the transactions are going up, but the actual gallons going out there are not. And then Fernando's got the whole thing right. We're down 25 refiners around the world. We're down a bunch of refineries that closed after the pandemic. And Fernando knows better than anybody. Dude, it's hard to open up a refinery that's the most complex thing in the world.
And back to your politics side of it, too. The president is trying to he's looking everywhere to try to bring prices down, except increase productivity. So you don't see that production. You don't see any more drillers that are going there. I know it takes time, but it would be really nice. That would be symbolic if he actually let us start drilling a little bit more than he shut down.
So, Fernando, we also saw the president mock the oil companies, and Chevron pushed back a bit. Is that the best way to be handling the situation?
I mean, I think, as Todd and Tobin were saying, it's very difficult to fix it in the short term. And even if you gave a federal tax holiday, that's less than 5% of the pump prices for consumers. So it's very nominal. It's not really a concrete step towards solving the issues. The refining industry in particular is very difficult for you to change in the short term. It takes 15 to 20 years to get payback on refineries. We did the analysis for one of the refineries that's getting rebuilt now after it exploded a few years back. That one at current margins, current 40-year high margins, would take over 8 years for it to get payback. So imagine a brand new refinery and assuming that we come back to earth, because that's ultimately the point of adding capacity. That would be a really long time. And the administration has said repeatedly that they want to phase out oil and gas by the next 10, 15 years, which we're seeing is going to be a lot more difficult to actually accomplish than was hoped.
Now, Justin, on that point, we do know that this is a very pro-green administration. Are you reshuffling your portfolio, or what's the long-term thinking of this?
Well, I think the writing has been on the wall for a number of months now, and we are definitely long energy and longer than the S&P allocation would normally dictate. I think the writing's on the wall that the president has no appetite to even engage big energy. They were in his White House just this week, and he couldn't be bothered to stop by for 5 minutes to say, hey, big energy, what's up? Let's try to address this a little bit and put it together. So,
Todd, what did
on weakness, I'm absolutely pressing my bets. And for clients that don't already own 5, 6, 8% energy, we're still buying.
Todd, what did you make of that? The energy secretary met in the morning with the oil and gas executives, and then in the afternoon, the president met with wind and power. So
yeah, isn't that great? Well, we got to get some of these executives on the show with us. I would love to know what they were talking about, especially now that you have the president saying, look, we want you to actually start producing more oil or more gasoline, but you're also going to be out of business in 5 years. So not a good statement, especially if you're working for those companies. I do have a question for Fernando, though. Since he is the oil and gas, he's an equity analyst at Bloomberg. I would like to know, when you start getting that type of rhetoric out of the White House, and you can only anticipate a windfall profits tax going to come down the pike, especially as we go into closer to the midterm elections, would now be the right time, even though as great as energy is, should you be an investor with those big oil companies?
Well, I think windfall taxes, even if you look at what the UK is doing, they're very hard to actually accomplish. And they started putting all sorts of caveats. And when you look at the US and the regulatory and legal framework here, it'll be very difficult for them to actually get something through. I think the sector is still generating significant free cash flow. I'm much more worried about the Fed engineering a recession than I am about a windfall tax per se. But the supply picture doesn't change, and it won't change in the next 5 years. The truth is we've underinvested since 2014, which is the original oil price crash of this cycle. And we haven't put in enough capital to meet demand at the current levels. And we haven't been growing that fast. The biggest issue would be emerging markets really taking a backseat. They've been the driver of growth over the last 15 years. But even then, I think when you look into a longer term horizon, if you're looking the next 5 to 10 years, we are well undersupplied. OPEC has an issue growing capacity. They're well underperforming their allocations, and I don't expect that will change in the next 5 years. They'll have some marginal growth, but everywhere else in the world, we're seeing declines. Even U.S. shale. I was talking to Justin about this before the show. We've tapped out a lot of the high quality inventory. So the ability to grow at the same pace that we did from 2012 to 2018 is long gone. We're not going to be at 18 million barrels a day in the U.S. anymore. That hope has faded a long time ago. So I think the supply side still looks very bleak. And so I would think that long term, the energy will grow as a percentage of the S&P.
All right. Excellent conversation, gentlemen. And thank you, Fernando, for joining us today. We hope to see you soon. Coming up next, the bulls were back this week on Wall Street as stocks snapped a 3-week losing streak. Is this the start of a summer rally? We discuss after the break. Buy, Hold, Sell Live, brought to you by Transformity Research.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average, stock average, over the last 2 years, but more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the NASDAQ's down 25% and going deeper. Let me ask you this, are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformativeresearch.com. Get on our free newsletter, transformativeresearch.com. Join us for free and stop losing money.
If you like Buy, Hold, Sell Live, be sure to smash the like button.
Lights, cameras, connectivity to every kind of screen, with 6 broadcast studios and experts ready to help plan the event. Big Wig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences. Let's get started.
Welcome back. Stocks finally showed some stability this week and moved higher in what has been a rough first half of the year on Wall Street. Is now the time to buy? To help us answer this question, we're bringing in Nicole Middendorf of Prosper Well Financial. Nicole, what are you telling your clients?
To not panic. And really, it doesn't mean just because we've had a great market that you go and run and you buy. You know, generally when people are, the average consumer, the average investor is panicking, that's what you don't want to do. And so the important thing is to buy low and sell high. And there's going to be plenty of opportunity here. It's not like the market's going to go crazy up. There's going to be plenty of opportunity to get in. And you don't just want to buy. You want to find some great investments and great stocks that you like and dollar cost average into them.
So hold on for the ride. Toby, we do know that we're going to get some quarter 2 info next week. What do you anticipate is going to happen, and how will that affect Wall Street?
Well, I mean, first off, let's just make sure everybody understands. The stock market is not the real economy. The stock market is the stock market made of a bunch of constituencies. One of those constituencies in the last couple of days said, dude, I think we hit a bottom, buy, right? And so, you know, we had what's known as short covering, because people who are betting against the market, if you look at the stocks that went up the most in the last 2 to 3 days, they're all the stocks that have been down the most. So a short covering rally is perfect with a bear market. I've done now 3 of these bear markets. That's why my hair is this color. The other issue is
Only
that
3?
She's absolutely right that what we're doing is we set the 50-week moving average. In other words, the price moving average at over a 50-week period, and that's our base case in a bear market, where we start to nibble on what sectors and what stocks that we love. Now, usually in a bear market, there will be some bad news that could be coming out in the next 2 weeks, particularly with big guidance down, with missing numbers. We're at about a 15 to 16 price earnings ratio right now in the S&P, but that assumes that we have about $250 of earnings per share on the S&P. If that comes down, remember, in a bear market, the first thing that comes down is the multiple. So we brought the multiple down. Now we have to look at the E. And if the earnings are going south, that means the price earnings go higher and we have more pain. So that's why we would do it over the next 3 to 6 months at these 50 and 200 day, and then you'll love yourself in 2 years and thank me, not Todd.
So Todd, do you think we're going to see a profits recession next week following this rally?
Yeah, I would say so. I mean, if you haven't sold into this week's strength, you're a fool. And this is a gift. I mean, you're going into the end of the quarter. There's probably a light volume. It is strong conviction though across the broader averages, because even bonds are down today. But and that's wonderful to hear. But realistically, going forward, especially going into next quarter, I mean, one of the biggest reports is coming out next Wednesday is the GDP number, and that's all eyes are going to be on that from Wall Street and Washington. They want to know where we stand. So going into that, and then you have the jobs report the following Friday. Yeah, I would have to suspect that now would be a great time to be selling, especially with the Dow up over 800 points a day. If you haven't sold yet, maybe you would think of it on Monday. But for the rest of this year, guys, you want to stay away from stocks. You want to start thinking about cash and holding on to that. And if you can get any leverage out of that, good luck to you. But that's the way you should go.
Justin, jump in here.
Well, I want to suggest that given by my haircut, I've been doing this for 40 or 50 years, and I've been through 4 or 5 of these by now.
Wow.
We have to remember that there are tremendous bear market rallies that happen in these kinds of economic
Yes.
time periods. And looking back into 2000, the market was down 45 and 51% from highs, met with rallies of 18 and 24% before we lost a ton of money, down 56% at the end of the year. So we're just 6 months into this. I want you to be patient. Let's sell these rallies. Let's keep our dry powder, and let's buy some weakness. I think that if we see 3,500, 3,400 on its way to 3,200, we should be big buyers. But as Toby said, this is a gift. We should be lightening up and selling the strength.
So we're hearing so many conflicting reports of people saying we are in a recession is coming, a recession's not coming until 2024. Nicole, what are your thoughts?
I was just at a meeting with a bunch of economists, and everyone was extremely positive that it's not going to be a recession, that we've never had a third-year term of a president historically with a recession.
Who are these economists? That's what I like to know. And were they drinking at the time?
But Nicole,
I'm not sure.
But Nicole, we've never had the only 8.3% inflation. We've never not had a recession, because the only way you get 8.3% recession down is to smother the economy. Number two, we've never had high inflation come down unless the Fed took their Fed funds rate higher than the inflation rate. Never, ever. So, I mean, this is not a run-of-the-mill bear market, because we had 12 years in technology, 17% annual gains in a stock market that's for since 1958, almost when I was born, that the market goes up about 10%. So we're in the give back section. We had a gift for 12 years, and now that's getting unwound. And you're telling me no recession? I don't buy it. And all the data I get, including the Atlanta Fed, next week is going to show that we're two quarters in negative growth.
They weren't saying this year. They were saying the recession. Okay. They were saying the recession wouldn't happen this year, that it would be into next year.
Okay, I'll go that.
So, do I believe that we're going into one? Yes. I mean, I was with a bunch of CEOs yesterday, and the concern is these costs of salaries and how much it is to employ people, and all of a sudden how that is going to change, because the CEOs are thinking about who do they lay off and when are they laying off people.
Yeah. So we are seeing some layoffs, especially in the tech sector. Then I just saw a report saying that job offers are being rescinded, and so that's certainly not a good sign. Todd, your thoughts?
Yeah, that's not good at all. And I have to suspect that with that, and you're going to have not just the jobs things, but also the layoffs are starting to continue. We just heard it out of Netflix. You're hearing it from some other companies. And I think once you start seeing those numbers go up, that's not a good metric for the future. So definitely stay away from stocks, and also be cautious about this economy. It's going to get really ugly.
All right, informative conversation, everyone. Fed Chairman Jerome Powell was on Capitol Hill this week, giving Congress dire warnings about the economy. What exactly did he say? Stay tuned after the break to find out. Buy, hold, sell, brought to you by Crosscheck Management. Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember. Oh, God. Yeah, well, I want you to, oh, my God. Fast-paced, no, oh, sorry.
Take one.
Fast-paced, no holds barred, in-your-face, rock and roll style.
Woohoo! Let's kick some ass.
I want you to smash that like button.
Track, cue, dissolve.
Good morning, and welcome
from Bigwig Studios. From the Bigwig Media Studio.
Bigwig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences.
Kudos to our team who's running around behind the cameras.
What I liked about working with Bigwig Media was you guys are the experts.
Our industry pros have you covered. Let's get started.
Jerome Powell appeared before Congress for his regular grill on the Hill this week and said higher interest rates could cause a recession. Toby, do you agree?
Well, that is shocking. Veronica, that's just shocking. He must have a PhD in macroeconomics. Come on, man. I mean, remember, they were the ones who made this inflation 10 times worse than it needed to be. He's now got religion. He's now coming to grips with the fact that, as I said before, there's no time in the history of the American economy that the Federal Reserve could have 8.3% inflation and another big inflation print next week and not have to take their rate above that rate. Because what we have in inflation is known as a supply and demand problem. We have more demand than we have supply. In order to bring inflation down, we learned this in the 70s and the early 80s when I was selling treasury bonds, paying 16%, by the way, that you can't break inflation until you break the mindset that everything's going to be more expensive next month. And you can't break it until you get these rates to the point where about 15% of the people who are going to buy a new home, a new car, anything that they finance, don't do that. The multiplier effect is what brings down demand. And we're just chewing around the margins if you think that, oh gosh, 3% Fed funds rate is going to change 8% inflation. It's not mathematically possible. He just can't tell the Congress or the people the actual truth. Sorry.
Right, but here's the thing. No, here's the thing. You had the biggest interest rate increase in 30 years. And the Fed, and he has been very transparent. I mean, give Chairman Powell some credit here. He has actually said, look, we need to raise rates. He's talking about the potential recession because of rate increases. But this is going to continue. I mean, now there's talk out of Wall Street that we were thinking September was going to be the final meeting with the final rate hike. Now they're looking at December we're going to have rate hikes for the rest of the year. And then you're going to start hearing the whispers. You're going to start hearing about people that are going to say, yeah, the Fed is actually going to raise rates all the way into 2023. Can you imagine this, guys, if that's the case? You're going to have mortgage rates closer to 10% and unemployment well into double digits by then. It's going to get really, really bad if that's the case, because I know he's being force-fed to try to bring down this inflation rate.
Justin, Chairman Powell had said that his soft landing is going to be challenging. What's your reaction to his testimony?
Well, assuredly, it's going to be an impossible task, and he may just pull it off. And that's because in addition to the dual mandate of price stability and maximum employment, I think there's a very unhealthy relationship today between the Fed and the market. And if the market starts to demonstrate weakness, 25, 30, 40%, they may just have to back off a little bit. And in a very rare criticism, former Fed President Bernanke criticized the existing Fed. And that's a huge no-no for retiring governors. He said that they blew it and they waited too long. And the truth is that they did, and now they do have to slam the brakes in the economy. A soft landing will be very difficult, but they may be forced to back off if the economy really starts to melt down.
Nicole, what are your thoughts?
Well, I was talking with a mortgage broker yesterday that was pointing out the amount of foreclosures and how that number has dramatically gone up and no one's talking about it. And really, I mean, if rates go up again, I bought a home last year. I took out a 15-year mortgage because the mortgage broker told me you have to do this because the money is so cheap. A little over 2% was my rate.
Wow.
If you do a 15-year mortgage today, it's 5.13% on average. I mean, that's a huge difference if I would have purchased my home this year versus last year. So,
Nicole, I saw that the delinquencies are just about 2.8% right now. It doesn't foretell a giant problem right now.
No, not right now. But what he was saying is that in the future, he said that all of a sudden things have just halted completely. And I mean, I'm in Minneapolis. We have lots of clients in Florida, and both markets here, you know, realtors are like, hey, there's no inventory, there's no homes, and people are not out buying and looking for homes. They're not refinancing. Gas prices are high. People are scared. They're concerned about a recession. And so that yeah, doom and gloom. That huge,
Well-
supply issue is not as what it used to be.
But Toby, isn't this
Well,
kind
let's
of
just-
what the Fed wants? And talking about the tools in their toolbox of what they're trying to do, they really want to rein in inflation, and obviously that's going to have negative impacts on a lot of other things. I mean, do you think that's what we're
Yes,
seeing?
remember their tools are only interest rates and cash money, right? So they put $3 trillion or $6 trillion into our economy over that period from 2014 through the pandemic, and actually until this month ago. Now they're pulling that out. When they're pulling that out, which means that those mortgage bonds, they became the primary buyer of U.S. Treasuries and mortgage bonds in the world. That's called the marginal buyer. They were price insensitive. They bought whatever was available. Now they're the marginal seller, which means that other people on the other side of the trade have to say, now, wait a minute, do I want to, pay that much, or am I waiting for the prices to come down, essentially, yields to come down?
They're also the marginal
and
loser,
prices
losing $500 billion.
Absolutely. So now we're in the spiral, and maybe because we're all so bearish, that's probably the sign that we should be bullish. But the stuff is starting to hit the fan, and you have to put down almost 40% more cash to buy the same home that you could have 2 years ago. Your mortgage rate, instead of for a $400,000 loan of $1,200, is now $1,900, and that's plus property tax, etc. That's the next shoe to fall, guys. There's no question about it.
All right, you heard it here first.
3% down payment.
Yes.
Okay, great discussion. Coming up, the traders get ready to debate a topic near and dear to all Americans. What is it? Come back after the break to find out. Buy, hold, sell, brought to you by Crosscheck Management. Hi, everyone. I'm Veronica Dudo, and welcome to Buy.
Hold, sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember. Oh, God. Yeah, well, that does. I want you to, oh, my God. Fast-paced, no, oh, sorry.
Take one.
Fast-paced, no holds barred, in-your-face, rock and roll style.
Woohoo! Let's kick some ass.
I want you to smash that like button.
Track, cue, dissolve.
Good morning and welcome
From Bigwig Studios. From the Bigwig Media Studios.
Bigwig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences.
Kudos to our team who's running around behind the cameras.
What I liked about working with Bigwig Media was you guys are the experts.
Our industry pros have you covered. Let's get started.
Americans could be on the verge of a housing crisis that rivals 2008. How bad do you think it will get, Justin?
Well, it's a great question. I don't think that it's going to get too bad as the short answer. Certainly things have worsened, but today there is a record tappable home equity of $11 trillion available to consumers. That's up a whopping 34% just in the last year. So the corollary is that 13 million adjustable rate loans were on the market in 2007. Today, there's just 2.5 million. And as far as resets upcoming, today there's just 1.4 million versus the 10 in 2007. So back then, people put 3 or 4% of their money down. They had adjustable rate loans, and the rates doubled from 4% to 8%, doubling payments. Today, we don't see that happening. So I think the biggest risk right now is affordability and recession and the strong rental market. It is becoming unaffordable to live in a lot of markets, and that might be the biggest risk to the housing market as we see it.
Toby, how do you see it?
Well, Justin has it right on. I mean, I would just add a couple other things. Obviously, back in 2007 or 2005, the running joke was that you could go to a strip club in Vegas and the girls would show you their portfolio of homes they bought with $1 down. I mean, we were literally, if you could fog a window or a mirror, you would, hey, you have a home, right? So that went away. Then the whole idea that you actually have to put cash down, that now is so we have a much more secure. The bigger issue is when we get to this point where we're actually getting layoffs and people who just bought the home, 6 months ago, 12 months ago, and when they go to sell, based on the data today, unless they're in a very small, really, really happening section of the United States, they would sell for less. We just had this in Phoenix and Scottsdale, where I am, where, everything is $2 million, $5 million, $10 million, right? Somebody who bought a $2.5 million, at $700 a square foot, by the way, house, had some financial issues, et cetera, just sold it for 1.6. He lost $500,000 in 6 months. Now, that's at the high end, but you multiply it at the lower end, it's when people get laid off, they can't pay that mortgage payment. That's when you start to see prices drop, and then equity values come down, and that sucks liquidity and, the ability to get a HELOC loan out. So we're not there yet, but we're starting to see the froth already come off, and then to have to put twice as much down and have to pay twice as much in interest, that's at least put a ceiling.
You know what, though?
Down.
I got to tell you guys, I mean, the whole conversation about, we might not be back in the 2008 situation. I think you're absolutely wrong. I definitely see it. I see so many people that went in and bought these houses. Look, Nicole just talked about it. She just bought a house. Now, she was fortunate to buy it. But you know how many Americans were out thinking that they had to buy a house earlier this year? Think about where they are. They're at the top of the market. That equity is being evaporated by the second right now.
That's true.
So when you start thinking about going down the line, I have to suspect, and we saw some big-time home sales metrics coming out at the beginning of the year, this is going to be really impactful. Down might not happen right away, but we will see something maybe by 2024. I think this is going to be a metric that we're going to look at back now, and we're going to say, God, we wish we would have probably did this and that with housing and maybe save some of these mortgage companies.
Nicole, is the housing market high risk?
I think so. Absolutely. I mean, I own a commercial building. I own a residential home, and my commercial building still is empty as well. Part of it. It's a tough real estate market all across the board. And I agree. I mean, it's going to get worse. I don't think it's going to get as bad as 2008, but you have the average American that is thinking a little bit differently because of the pandemic. They're changing how they're earning money, where they're earning money. Many people went out and bought boats and are really just having this, in my opinion, a laissez-faire attitude about life. And now they're having higher gas prices, and they went out and bought that house or did the remodel that they've always wanted to do because of the pandemic. And now all of a sudden interest rates are higher and they're already at a crunch, and then they get laid off. It's just going to get worse.
I'll suggest that I think the sector is uninvestable. When we have a record shortfall of housing supply, and lumber and all the input costs are higher, and those margins are going to get continually squeezed. They're down 40%. So it just feels incongruous, and I don't want to be a part of it.
I'll tell you one place you want to stay away from. Think of those luxury home builders. Think of a company like Toll Brothers, symbols TOL. That's a company you definitely want to stay away from. I can definitely see them being the leader, the loss leader in that industry.
Well, let's not also forget, remember that when a home builder, a large one at least, that do more than 100 homes, they sell the homes in advance. They don't build the 100 homes. They have 3 models and they have land and they build. So the ones that have already pre-sold homes and the mortgages are already fixed and the down payment's already been made, those home builders are actually going to benefit because, Todd, I don't know if you follow lumber prices, but they're actually down 40% in the last 4 months because guess what? Nobody's building houses. So we have a little window here, but I'm with you that the stocks are uninvestable at this point. And if you're at home and you want to buy a home tomorrow at the high price, wait 6, 7, 8 weeks, 10 weeks. The prices will be lower.
All right, informative discussion, everyone. And thank you, Nicole, for joining us today. We can't wait to have you back on Buy, Hold, Sell. After the break, the traders open up about Wall Street's newest fad, meme stocks.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average, stock average, over the last 2 years, but more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the NASDAQ's down 25% and going deeper. Let me ask you this, are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformativeresearch.com. Get on our free newsletter, transformativeresearch.com. Join us for free and stop losing money.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
welcome back. Cosmetics giant Revlon filed for bankruptcy protection last week and in a twisted reaction has soared well past its 52-week high in what many are calling Wall Street's newest meme stock. Toby, for people who are watching and may not know, what is a meme stock?
Well, a meme stock, you have to go back to social media and you have to go back to, January 20 and January 2021 when people on Reddit and on Stock Tips and Yahoo and Twitter all decided that if there was a stock that had a huge short position, meaning that a whole bunch of hedge funds had bet against it, you could rally a whole troop literally of 10,000 people to buy their stock, on their phone, on their Robinhood account. And that stock would go up parabolic because when you short a stock as a hedge fund, trust me, you have to borrow money to do it. And when you borrow money and all of a sudden it goes up 50%, then the cashier at the brokerage firm calls you and says, Toby, you need to put another $20 million in to get over.
Is that Justin calling you?
Yeah, it becomes a perfect circle. So we had 3 hedge funds, and one, a $25 billion hedge fund that went broke in 60 days because these guys attacked it. So it's basically a social media buy, with market orders, not limit orders, and it works for as long as it works. And then you short the hell out of that stock because those guys run out of money.
That's right. Well, listen, so on that Revlon talk, Revlon, the story for all the viewers out there, the company files for bankruptcy, and it really wasn't a front page news story because it's Revlon. It's been around for 90 years. You could still go to a Target or a Walmart and buy the Revlon product. But the stock, after it filed for bankruptcy protection, Chapter 11, the stock shoots up 91% the very next day. And guess what? The day after that, it's up another 50%. So everybody is definitely trying to front run this thing. The stock was up another 10% today, but actually crossed closer to $9 a share. They're close sub $8 a share right now. But you have a lot of people, a lot of sucker money in there. That's what I call these meme stocks, where you have these message boards and they're saying, buy this stock. You got a lot of suckers that will actually buy it, and then they're going to be the last ones because they're going to be the losers in the race.
Justin, does this make you nervous? Do you think meme stocks are a fad, or are they here to stay?
Oh, I have so many thoughts on the topic, I don't even know where to begin. This is just absolute absurdity, trading on the idea of the greater fool theory. And all these home gamers are trying to be hedge fund traders, trying to understand the balance sheets of these companies. The debt is trading for 10 to 30 cents on the dollar. And if we don't know what that means, it means that the equity will be worthless. There's nothing here. So if you think you can participate in this game, you think that there'll be a rescue plan. If you think a million things could go, I don't know, 1,000% more correctly than they possibly could, then by all means jump in. But I tried to short the stock and I couldn't even get a borrow on it. So I think it's just a waste of time. I don't know. I don't even want to talk about it anymore.
Yeah, but you know what's funny about it? And Toby, let me jump in here real quick, because the one thing about these meme stocks is that they usually get pop culture to actually jump in and start talking about it. I mean, not only here we are, we're talking about Wall Street and money and monetary policy, et cetera, but when you start looking at Revlon, they were actually profiled in Entertainment Tonight about their stock. Think about that. Then you get every one of these people, they love the glossy magazines and all. They're the ones that are actually investing in this, and then they're left holding the bag when the real investors get out.
Right. Let me make one positive comment. Ron Perlman's a very smart guy, and he owns 85% of the outstanding shares. So it is possible he could engineer a rescue plan here in his own self-interest. But
Justin, is he behind this?
Yeah, it's
good question.
No, he's not. He's an insider. He can't do that.
Sure. No, he's
but
not,
his cousin
not,
posted something on Twitter about it.
But just remember this. There was 42 million new brokerage accounts opened after the stimmy check started coming. That is what launched memes, stocks. It's all social media. It's TikTok, because that's where you really want to get your investment advice, is TikTok. And the whole deal is because of the power of social media. If you have 100,000 people putting a market order in to buy Revlon, that stock is going to go up 50 to 80% until all those orders run out. If you want to play the game, it's a day-to-day game, and you play the options. You don't buy the stock, you buy an option, and that's where you make a huge gain or you lose a little bit of money. The other side of that is because there's options are so involved in this, when there's a lot of people buying options, the prices go up because the people who make the options have to buy more stock. I mean, it's just a crazy little quirk. About 22 million of those accounts have already been closed at zero, meaning that half of those people have lost all the money they put in playing this game. And if you want to play the game, but you're not investing, you're speculating on crack.
You know what? I'm going to give you some breaking news here, guys. If I'm an investor and I do not own Revlon stock, but I would buy Revlon stock. If you you always see they're always off the shelves. I'm guessing they're always selling out of their product, or maybe they're just not filling them up. But that's one company I definitely would consider for a portfolio.
I want to get
Todd, what are you doing in the makeup aisle? I'm confused. I'm very confused.
Look at this. I need the makeup for TV.
Well, it is an iconic brand, that's for sure. Awesome discussion, guys. Coming up next, let's make some money. Buy, Hold, Sell Live, brought to you by Transformity Research.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average, stock average, over the last 2 years. But more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the Nasdaq's down 25% and going deeper. Let me ask you this. Are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformityresearch.com. Get on our free newsletter, transformityresearch.com. Join us for free and stop losing money.
If you like Buy, Hold, Sell Live, be sure to smash the like button.
Lights, cameras, connectivity to every kind of screen, with 6 broadcast studios and experts ready to help plan the event. Big Wig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences. Let's get started.
Predictions, let's make some money. All right, Todd, what's your buy, hold, sell this week?
Well, now that we have our friend Justin Wine on the show today, I have to say I'm going to buy Twitter. I know how he feels about it, but here's why. Twitter actually announced yesterday that they are going to be giving additional data on those fake accounts to Elon Musk, and evidently there is a interface program they call it API, and that API for you techies out there, Toby. And because of that, Elon's going to get a lot of information here, which will help him strategize and move forward in this takeover. You will actually see Twitter bounce up, and that would be a quick trade I would look at for it tomorrow, or I'm sorry, on Monday, and then going into the close of the quarter might be something to really get a quick pop for you. I would actually hold on to, there's an ETF out there called, the symbol is DIG, D-I-G. It's a ProShares Ultra Oil and Gas Sector Index ETF. It's actually a leveraged ETF that covers all of the oil and gas stocks that are out there. That's definitely one I would hold only because we've been so bullish on oil for so long. There's good reason for that. And I'm going to sell Target. The stock crossed 150. It did rebound a little bit. Definitely well off. It's off over 30% this year. But with that little bump, if you haven't sold it already, take advantage of it and get out.
Toby?
All right. Well, I'm buying. I'm starting to nibble now on the best of class enterprise software as a service companies. Probably one of the top 5 is Workday. WDAY is the ticker symbol. They're integrated into 160 of the top 200 corporations in the world. You can't get rid of Workday. And what they're going to be doing is, they're going to be doing at these low prices some acquisitions. So you can nibble at it. Again, I'm nibbling at the 50-week moving average. That's where we're finding support. You know, on hold, I'm still holding are the mortgage REITs that we talked about, because as interest rates go up, some of these ones, like we've talked about, NRZ in particular, is generating 13-14% yield, and their value is going up. And then selling, frankly, guys, on June, just a week ago, before the show 2 weeks ago, we sold our energy, all that part, because it went straight up. These momentum people got into it. And we sold it because, you can't buy a stock for $3 and it goes to $6 in 3 weeks and not sell it. So I'm waiting for oil and gas. I love DIG, but I want it again to come down to the 50-week level.
Justin, what's your buy, hold, sell this week?
Well, I am nibbling on the big FANG stocks. So I continue to like Google and Microsoft and Amazon and even Netflix. I think these are representing good relative value.
Definitely.
I'm buying cybersecurity because enterprise spend is going to continue to be high. I would invest in productivity stocks. If we're having labor hiring problems, we're going to invest in software. Spot on, Toby. And then I wouldn't mind being long Twitter around the low 30 levels.
There you go.
40 feels rich, but Elon's going to negotiate and leverage this down a little bit. So maybe we see a deal at 35.
I'm converting them, Toby. I'm converting them.
Justin, you do a great job. You don't have to kiss his butt. We'll invite you back, okay?
Well, he is down 30% from the last time he called Twitter, isn't he?
Oh.
That is true.
You should feel sorry for me.
No. I love you, man.
All right. Thanks, gentlemen, and thank you, everyone, for joining us on Buy, Hold, Sell for Tobin Smith, Todd Schoenberger, Justin Wine, Fernando Valle, and Nicole Middendorf. I'm your host, Veronica Dudo, wishing you a wonderful and safe weekend. We'll see you next week on Buy, Hold, Sell.